On Friday night, we got some pretty big social media news. We learned that Elliott Management, that's that relentless activist hedge fund, had taken a sizable position in Twitter and demanded CEO Jack Dorsey's head on a silver platter. So what does it mean for the stock? Twitter stock just roared today. It vaulted nearly 8%, buoyed both by the activist involvement and the market-wide rebound. I just recommended this one a week and a half ago, arguing that Twitter had some of the best momentum in the social media cohort. I liked the changes that were happening. After the latest very strong quarter, it looked like the company had gotten its act together. I think it may have. Remember, Twitter disappointed big time when it posted its third quarter results in October, and the stock got slammed from 38 down to the high 20s. At the time, I told you it was worth buying. I figured Twitter would become a takeover target if its shares went any lower. Since then, the stock's up 20%, even after last week's gigantic coronavirus-induced sell-off. When the company reported its most recent results a little less than a month ago, the numbers weren't perfect, but they were much better than feared. I said the bottom had been put in and again by. Twitter's invested a lot of money in improving its platform, and that's resulted in huge user growth, coupled with very robust revenue growth. So why is Elliott getting involved here then? They haven't submitted a big list of demands, but from all the public reporting, it's easy to see what they're really after. First, I expect Elliott to make the argument that Twitter's been a long-term underperformer under the leadership of co-founder and CEO Jack Dorsey. From the beginning of Dorsey's second stint as CEO, starting in July of 2015 through last Friday, Twitter stock had a total return of negative 6.2%. S&P up 56% total return. Over the same period, NASDAQ returned 80%, Facebook returned 121%. Facebook been under assault endlessly. Now, you could argue Twitter's finally gotten its act together, but even over the last 2 years, it's still been a real laggard. It's only returned a little more than 8%. Basically, I'm betting Elliott will argue that Twitter has a great platform, one that's become central to global news and culture, yet somehow the company has been able to monetize that platform effectively. To put it another way, Twitter's a $28 billion company, Facebook's a $560 billion company. Facebook deserves to be bigger than Twitter, but 20 times bigger? It's not hard to make the case that they've been doing something wrong. At the very least, Twitter's undermanaged. I mean, it's literally undermanaged, which brings me to point 2. Elliott wants Jack Dorsey gone. I like Jack. I think he's a very smart guy. But his critics say that he's the human embodiment of hubris, and there's plenty of evidence of that. For nearly 5 years, he's been the CEO of 2 large publicly traded companies, Twitter and Square. I've never liked that. In other words, he's a part-time CEO. Late last year, Dorsey said that he wants to spend up to 6 months a year in Africa, which would make him a quarter-time CEO, although, of course, I'm sure he telecommutes. It does make you wonder, though, how would Twitter do if it had a CEO who had only one job? The Twitter devotees always immediately point out to how much Jack is loved internally, which I'm sure is true. Half of Jack is better than 100% of many other CEOs, they will say. And the last quarter, which I like so much, is certainly an argument for that. What else? I'm betting Elliott will point to the fundamental lack of innovation at Twitter. They'll argue that the product has barely changed under several years of Dorsey's leadership. Sure, they now have let you have 280 characters rather than 140, but that change was years in the making. It took years for Twitter to let you hide replies or follow topics rather than just use other users. Why does it take so long for Twitter to adopt new functions? Well, Jack Dorsey has a reputation for being a see it from all angles kind of guy. In the parlance of Twitter, you could say he has a galaxy brain management style. I think there's real value in not pushing through changes too quickly. Twitter's a popular platform. You don't want to screw it up. But on the other hand, you can easily see how this kind of management style could end up turning into indecisiveness. They're indecisive. Why does Elliott want Dorsey out now? Well, some of it is probably because 2020 should be a gigantic year for Twitter. Got the election, the Olympics, now the coronavirus outbreak. They're going to have a huge audience, and these activist shareholders want that company to monetize that audience effectively. Plus, as Bloomberg reported this morning, Elliott met with Twitter's executive last week, and you know who wasn't there? Jack Dorsey. They spoke to the chairman, who's Omid Kordestanian, and the lead independent director, Patrick Pichette, but not the CEO. Again, there are times when Dorsey's Zen-like attitude is admirable. This wasn't one of them. In response, even some of the most bearish analysts on Twitter have backed away from their negative pronouncements because something could happen here. ISI Evercore had a sell rating on it. They were basically telling people to short it. Now they've upgraded to neutral because they're worried that Elliott might push for the company to put itself up for sale. No wonder the stock surged today. Now, I think it is worth noting that Don Bilson, he's over at a place called Gordon Haskett, he actually predicted some activist involvement in Twitter just a couple weeks ago. So what does he think of the move? Well, while he believes the stock has a ceiling at 40, he also says it could break through that ceiling if Elliott brings in new CEO who's more focused on making money. And Bilson thinks that there's a decent chance that could happen. My view. First of all, I think the stock's worth owning here no matter what. Although, after today's run, you might want to wait for the next market-wide pullback before you really back up the truck. Hey, we just had that kind of pullback. They do happen. And you know what? You made it out like a bandit if you use it to buy Twitter into that weakness. Fundamentals still strong. I think the company's got a lot going for it. In short, Twitter was a buy before Elliott got involved. And regardless of how this story plays out, I think Elliott's involvement makes it more attractive. Will they be able to replace Dorsey? I don't know. On the one hand, running two publicly traded companies at once is the ultimate act of hubris. And if he's forced to pick, I'm guessing he'd go with Square because that has faster growth. On the other hand, Dorsey's a co-founder. Notoriously hard to get rid of those guys. At the end of the day, I think Elliott's actually right. It's unacceptable for a chief executive officer to be your side hustle. It's ridiculous to be a part-time CEO who spends 6 months a year hiding out in Africa. It's time for Jack to come back to work with the troops at one or the other company. He's built two great companies. I think it's terrific. Bravo. But I got to imagine the board's patience is wearing thin because this isn't bad corporate governance. It's no corporate governance. If Elliott can succeed in electing 3 candidates to the board, I bet this is going to happen. Bottom line, I think Twitter's a buy, whether Jack Dorsey's running it or not. But at this point, I think the best thing he could do for his shareholders is just retire as CEO of Twitter and focus on running Square full-time or vice versa. How about Joey in Minnesota, please, Joey?
Booyah, Cramer. Hello from up north in snowy Minnesota. We love you up here.
Oh, thank you, man. It's real cold there. It's just getting spring here. What's up?
I love it. I love it. So I wanted to ask about Revolve Group. You had a great optimism for this stock in 2020. I own the stock, purchased around New Year, $19 a share, down to $15.50 per share as of the end of today. What are your thoughts on guidance for 2020 moving forward? And this being an online shopping retailer, will the coronavirus affect this stock positively?
I had thought that an online shopping retailer would be the way to go, especially in a period of a coronavirus. The quarter was not that good, and I'm looking wrong. And I'm not going to say double down because I'm not a big fan of retail here, and I wish I'd gotten this more right. Let's go to Patricia in New Jersey. Patricia.
Hey, Jim. Love your show.
Thank you.
You're the best. You're
Thank you.
best. The professor.
Oh, there you go.
I bought IQ at an average price of 28,
Right.
and it's been a roller coaster. And I'd like to know your feeling on that stock and how the coronavirus might affect
I'm not
it.
a fan. I think that the stocks are the only stock I'm recommending in China is Alibaba. It's very much similar to U.S. Financials. I think this stock is a sell, not a buy. Right. Twitter is a buy with or without Jack Dorsey running. It's time for Jack to make a couple of decisions, soul searching. There's much more mad money ahead, including my exclusive with Pegasystems. How could the company perform in an uncertain market? This thing is more than triple since we first got talked about it. Then, is it possible to put an accidentally high-yielding portfolio together this type of market? I'm eyeing 10 stocks that might not be on your radar. And all your calls are rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.